Welcome back, fellow traders, market participants, students, and hangers-on. We find ourselves this morning in a market which just kind of had a little hiccup downward as they announced that the China meetings may be delayed a little bit. Not too surprising. Different people will analyze this in different ways, and when I say students, I'm not trying to be arrogant and obnoxious. I know a lot of people come on with these stock market videos and are very arrogant and obnoxious, and I'm certainly not one of them. In fact, one of the main points of my lessons is that nobody knows what's going to happen, and especially me. One of the big pieces of wisdom that market participants get as they become more experienced in the marketplace is the knowledge that they do not know what's going to happen, especially very short term. Anyway, wanted to give you the update, talk about volatility, the VIX and whatnot, and give you my impression of things, and we can move on from there. First of all, let's go to ACB. Now, I publicized widely that I've been long ACB, and we've got earnings coming out, supposedly the 11th, although we're not positive of that. I did find an interesting article on ACB and Seeking Alpha, which we'll pull up right now. Now, Seeking Alpha, different people have different impressions of this site. I have several friends that write for it, and thus their impression is this is a great way to earn a couple extra bucks. However, the other impression many have is that this is sort of like they tend to do a lot of pump and dump stuff. These plans for you to sign up seem quite expensive to me. $199 a month, really? For what? For research, I suppose. Anyways, if we pull up ACB, Aurora Cannabis, we can see there's an article, Why Oversupply Concerns Are Overblown. Check that one out. It talks about how, well, basically the infrastructure to disseminate or to sell cannabis in Canada is still getting it kind of in place. There aren't that many stores yet, but there will be, and there's competition with the black market right now, but that should sort itself out a little bit, all in favor of Aurora Cannabis. Aurora Cannabis also has contracts in Germany, et cetera, et cetera, et cetera. Now, let me emphasize that I cannot analyze this information better than research firms and the hedge funds who pay their employees a lot of money to analyze this. So you're not going to get an analysis from me that's going to trump just what other market participants know. We have seen, along with the cannabis industry, you can see the chart here behind me of Aurora Cannabis. If I get out of the way for a second, it's gone straight down for a long time. Looks very similar, of course, to the MJ chart, right? This is chart of the whole industry, in a sense, the MJ ETF. So anyways, I did get long this. Let's zero in on the Aurora chart for a second. I publicized getting long this, and I said, I'm just getting long it for a little pop. And I stuck to my guns on that one, so I bought it for $360. I did get a little pop, and so I decided I'll just bail. So I just bailed. I bailed this morning. I took 25 cents out of it, and I'm happy with that. And we'll look to maybe reload coming into earnings. But I'm a little nervous coming into earnings. I read another research report saying that that it's definitely going down to $2 and change on earnings. They want to put all my eggs in the ACB basket because I've lost that way before. And, booking a nice, several $100 gain in a couple days in ACB seemed like a good deal. And so I just bailed. I've been investigating a little bit this whole dividend stocks thing. There's a lot of guys online that are quote-unquote dividend investors, and they invest. Their whole thing is like buying dividend stocks. And to me, dividend stocks was always like the kind of thing you do when you're like an old person, you got tons of money. It's just a way of like having stuff automatically give you an income. remember when you buy a dividend stock, and I was watching a bunch of dividend videos online. The thing is with dividend stocks, okay, there's several things at play, right? There's the dividend yield, which is how much the dividend pays each year as a percentage of the stock price. But also the stocks are moving up and down. So if you catch a stock that's like in a downtrend when you buy it for the dividend, then you might make a little money on the dividend, but you're going to get hosed on the stock price as it goes lower. So like any other stock purchase, it's best to try to buy dividend stocks when you think the stock's going to go up, which is, I don't know when stocks are going to go up, so it's hard. Anyways, I'm not totally discounting dividend stocks. I think they're a good deal, and certainly if you're going to do stuff for the long term, it's a great deal. Now, the Dividend Aristocrats site, which I was looking at, let me see if I can pull that up now. A lot of these names, almost all of these names you've heard of before, and they don't sound like bad companies to own, right? Coca-Cola, and seems like a good idea to me. I don't see anything wrong with holding these Dividend Aristocrat stocks. I guess what it has to do with is companies that not only have dividends but kind of increase their dividends every year. Okay, so here's some of the list. Procter & Gamble, 3M, Coca-Cola, Johnson & Johnson. So many people love Johnson & Johnson. So many people love Colgate-Palmolive. So many people love a lot of these companies, and I don't see anything wrong with that at all. In fact, this seems like a great way to invest, but you need to put stuff in for the long term, of course, and you should try to catch stuff in an uptrend if you can. Let's take a look at a couple just really quickly here. I'm going to get, and then we're going to get to the volatility stuff. Okay, so ABBV, you can see this, it's freaking come from 73 to 82 in the last month, which seems like kind of a big move. However, not a hugely volatile stock. I suspect when we look at the options, it'll be about a 20 vol. Yeah, a lot of these are like 20 volatility, so not real volatile stocks, which is, once again, good if you're investing in them, I would say. And the market seems to be kind of recovering from that blip. Let's take a look quickly. I'm going to jump away from dividend stocks, and let's look at what happened with this announcement with China in the last few minutes. You're going to see all of a sudden there's this like knee-jerk reaction, like something happened, this would happen on the floor all the time. Like all of a sudden stuff goes crazy. You're like, something happened. You can see this move. It's like spike and down. See if I can blow it up even more. This move here all over the place, and then it stabilizes a little bit. That was the announcement that China's delayed talks, and you can see stuff really stuttered for a second. All right, so I am still short volatility. I'm still short synthetically short call spreads. There's two ways of saying it. Either I'm long the put spreads or synthetically short call spreads. It's the same thing, really. Basically, UVXY needs to be 19 strike or below and or 20 strike or below on December expiration in 40-something days for my positions to be a maximum. So what that means is that UVXY needs to stay here or below. And the calculation I'm using is just that this thing's decaying very rapidly. We can see front month contango is 10%, which means that this thing's decaying by like about 50 cents per week currently with contango there. Let's get into that. Let's look at our term structure and talk about volatility. All right. So it's this situation where if it wasn't for the term structure, and if you could just buy volatility, then if you could just directly buy the VIX and there wasn't the drag of a term structure, then this would be a good place to buy volatility. The VIX is 1308 right now. If you could buy 1308 vol, then that might be a good place to buy it. However, all you can buy is the futures, and the futures are 15 and 1650 right now. So you can't buy 13 vol. You can buy 15 or you can buy 1650. And we're a little bit past halfway through the expiration cycle. So that means that that second month D's futures are becoming dominant here. And they're just pretty far above spot. Now, it wasn't the extreme that it was a week ago where it was like 4 points above spot. However, 3.5 points above spot now is a lot. It's just under that right now. The front month future being 2 points above spot, that's kind of expanded in the last day or so. And, we saw the VIX come in a little bit today, and the futures just weren't following it that much. So because, like I said, if all things were equal and there was no term structure, then I would say it would be a buy the VIX right now. But because of the term structure and the drag inherent in it, things are much murkier. Okay. When you go online and you look and you listen to people talking in like a forum or even in videos, they're going to exude this charisma, this certainty, like, yes, we're going to make money. Yes, this is what you need to do. It's obvious. The reality of the market is it's never completely obvious what you should do. There's always murkiness, and that's what makes it hard, and that's what makes a market. That stuff is priced as accurately as all the market participants put together can price it, and thus it should be priced in a spot that's hard to figure out what to do. That's what efficient pricing is all about. And thus, it's hard to figure out what to do here. And in my mind, it always is hard to figure out what to do. That's except for some brief, rare moments. However, we've got contango of 9.57% right now. And if you'd gone back a few months ago and looked at the videos that I was coming out, or if you looked at my tweets and then the responses to it, you would see that right before expiration, contango would expand to like 12, 15%, whereas during the normal, like this time in the cycle, it was like 5, 6%. And when I would have a video highlighting all contango is 12% now, there would be a lot of pushback from other volatility people, experts, or people writing about volatility, saying, well, volatility is not really 12% here because it's an average. UVXY is based off the SPVXSP and that is reflecting a lower contango than 12%. However, we're in the middle of the cycle now, and 9% contango, if I was to publish this 9% contango, you wouldn't get that pushback right now because legitimately the thing is 9% contango, which is high. And even the contango between the second and third months is over 5%. If you'd gone back a month, the second to third month contango could have been anywhere between 0 and like 2 to 3%. But now, really, they've kept the futures high with the spot low. And as that builds up over time, these things legitimately decay. There is a very real case to that these things are decaying very rapidly. And that is the case for being short volatility. Now, what's the case for being long volatility? I'm going to put two cases out here, and it's just going to make you be like, oh, well, what should I do? I'm not going to provide clarity for you, I don't think, but I am going to explain the situation to you. Sometimes there isn't clarity. In my case right now, there's not clarity, and that's okay. We live in an uncertain world. I've chosen to stay short volatility. You might choose otherwise. All right, so the case to be long. Well, the thing's gone down a whole lot. Some of the people I respect the most who trade the VIX and volatility are like, you would be crazy to be short here. This really is a sucker's bet to be short here because we're taking out the all-time lowest still after a long time. Volatility is historically low. I did get in a dispute with somebody about how they were saying that like it's not that low, 11% volatility, the average. And I was saying to them, no, yes, it is. The average is 18 to 22 for volatility over time. And they were saying, well, I don't mean the average over time. I mean the average right now or something. I don't know what they were saying. But anyway, I was making a case against myself saying that historically volatility is really low right now. And that's part of the case for being long it. The other part, it's been going down for a long time. We're due for a spike at some point here. That's the other case for being long it. You really are picking up pennies in front of a steamroller now. The other case for being long volatility is just that even when the market is rallying and we had E-minis up, the VIX was not responding very well. We had the market up with the VIX up a couple days in a row, and we also had VVIX climbing. Now, strangely now, it's like the market's down. Well, not really. E-mini's down 3, VIX down slightly, VVIX down slightly. Let's take a look at the VVIX here. We've seen a precipitous rally in the VVIX, and many people, and I agree with them, like to say how with the VVIX, it's not the actual prices, like 100 isn't like some inflection point, but it's the trend that we want to follow. And we saw this trend, and I can get, as I've said many times before, you can pick a time frame that will justify your argument, whatever that argument may be. But let's go to a 30-day time, let's go to a 90-day time frame just to illustrate what I'm trying to say here. And you can see we had this trend in the VVIX from like 100 just down, 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 down until we got to this like last week in October. And then we see this stuff start to turn around, right? Boom, back to 90 all of a sudden. This is, kind of reflects, well, what does it reflect? It reflects options buying in the VIX, right? I was making a point last week that some of this options buying was downside puts, right? Put stupids, whatnot. But I was looking at time and sales yesterday and did confirm that people are buying out of the money calls again. So this is a reflection of the fact that there are people buying VIX stuff right now, definitely. However, all this activity has been pretty muted. Not much has been going on. And the longer we go with not much going on, the more time this decay has to just really happen. And with my position here, the thing for me is like, yeah, there's going to be spikes. Yeah, stuff's going to happen. However, the more time that goes by, the longer, the lower UVXY is going to get, and it's going to start to move away from the strikes that I'm short. Remember, because I'm not just naked short the stock. I'm short specific strikes that I'm looking for this to be below on expiration. Let's take a look at the position here real quick. My whole position's in December. And we are short, basically we're long these put spreads. We're long the 22.19 put spread and the 23.20 put spread. So we are looking for UVXY to be below $19 in 44 days. That's the whole dealio with the position. And I'm going to put a bid in for these 12 puts. I've been bidding for these 12 puts just as a backstop because I figure if I own a couple of these, then if this really does make a move way lower, then I can, if I'm long the 12 puts, I can sell a fatter put against it to kind of turn some of this stuff into a condor. So buy some cheapo puts here, hold on to them. I can always get out of them, or even if I don't get out of them, they're dollar cheap, $2, $3, $4, that sort of thing. And then look to sell some maybe 15 puts against them if we start to crank down through maybe 17, 16 here. My other idea is the delta we're showing for the position is short 400. If we do start to crank down to 17, 16 here, maybe even just buy some UVXY actual shares, because shares would fit great against this position, because shares are going to continue. If we do get it like a legit spike, shares are going to keep helping us out even through these put spreads, because this goes to 30, you're long 100 shares. Well, that's going to, even when this put spread stops hurting you, the shares are going to continue to help you. So looking, if we do get a continued move down, maybe to buy some shares to hedge my short here, just because, like I said, they fit the position. But the other idea, it would be to sell some put spreads below here. I like to keep it simple up until now and just be long these put spreads, but we'll see what happens. Like I said, the market's not really been doing a whole lot, and that benefits us being short volatility, obviously. As much as the futures traders try to keep the futures up, and as much as they don't want to bring them down to meet the VIX, time starts to, it's almost like a hot potato thing where somebody's holding on to this premium, somebody's holding on to this long, and at some point, if you're long volatility, if you're long options, you're going to get hurt if nothing happens. It's just the inevitability of what you have on. And thus, short volatility, even though they don't want to let it pay you, and even though they keep UVXY, in the same spot, if nothing happens in the end, they got to pay you because the actual volatility doesn't match what you paid. I want to take a look really quickly at our overlay charts because I think they're interesting. So let's take a look at one of them. I was looking at a couple of these this morning. Tell me what you think is interesting here. I was looking at VIX versus VVIX. And so this is the question we might be trying to answer here would be is this not going to work for me? The question we might be trying to answer here would be does VVIX lead the VIX? Is it an indicator that we can use ahead of time to figure out what the VIX is going to do? And good, it worked. Yay. And if we look at VVIX over, let's go to 180 days, and we look at some of these volatility events, and I did that wrong because I need to do VVIX, not VIX. So does VVIX lead the VIX? Is a leading indicator? And we've always said it isn't, and I can graphically illustrate that it isn't here as well. In fact, a couple times this year, VVIX has not done anything right before the VIX popped, and it's kind of interesting. So let's go to 1 year. And we've got VVIX. It looks different than what I was looking at before. So VVIX would be this purple line here, and VIX would be the, that's a little bit better. Maybe we should do it the other way. VVIX on the main thing here, and then the study would be VIX. And you can see that, so now this is VVIX and VIX, and you can see that they kind of follow each other, but it doesn't look like one leads the other. It looks like their stuff's kind of happening right at the same time here with these. That's what I kind of see. Right here, it almost looks like VVIX leads the VIX, but it's not conclusive as far as I'm concerned. All right, so let's look at UVXY. Remove all studies. And we can just see this move down, move down, move down, and it's just it's been very steady. And we will get some pop at some point, but imagine if you shorted UVXY at 94 here, you just would have made so much money as it went down. But you got to live with this pop here from 30 back to 40, another pop here from 22 back to 38. And I know a lot of people have reset and either have reset or gotten long here. Some, there is an idea by a lot of people to buy either at the money or out of the money calls and get long here for the pop. And that could potentially work. You're going to suck wind as on all these days between where stuff goes lower, you're going to suck wind. But if you can hang in there, there's going to be a pop at some point and you're going to either make money on them or at least get back most of the money on them. And the best thing is you're not going to lose money during the pop. You might lose a little money as we grind down now, but you're not going to lose money in the pop. If you really are somebody who just is uniquely patient, you could take off any position you have in the VIX right now and hang out until an actual pop comes. That's the best way to guarantee that you don't lose money. However, in the meantime, you're not making money, so it's always a question of what to do. And as I said before, the answer is not obvious. This scenario that's put forth by so many people teaching trading is that all you have to do is learn how to trade, and then from then on, you're going to make money all the time. And I personally don't think that's true for anybody. I'm sure there are some outliers there who have made money all the time and kind of have sort of understood things, and from once they understood things, they made money all the time. But as far as I understand it, it is a continuing learning process, and it can be a continuing struggle. My P&L has not been steady. I've made money, but it's never been like, okay, this month you made X, this month you made X, this month you made X. It's been more like erratic all the time. So don't be surprised if your P&L is a little bit erratic, because that happens with a lot of people. So that's kind of where we stand in the VIX right now. The all-time low is 1773. We're off that. We're around 19. We're hanging out, but nothing too radical has happened. And as long as we just stay with nothing too radical happening, UVXY is going to continue to decay here. So monitoring it closely, but UVXY continues to decay. I'm satisfied that ACB, since I sold it earlier today, has gone lower, and maybe might look to reload if we get to a lower point here. I read an article that was saying how like ACB is in bad shape, and they're going to have to dilute the stock by offering more shares because they're just running out of money. It was saying how the stock Cron is so much better, and also Canopy Growth is so much better. However, both companies, they all look the same to me. There was another company that was calling for this is the bottom in MJ stocks and time to load up. Now, certainly a better time to buy than any time before in the last year, right? Because we're way down here. Things could though continue to go lower. Certainly, I suppose the chart seems to have kind of stopped going down for the moment here, but we don't know what that means. One thing that I can tell you with certainty, however, is that if you are interested in maybe trying to buy some value here in MJs or whatnot, a better deal is to buy the actual MJ ETF than any particular equity, and that would be the way to go as far as I'm concerned. That way, if the industry in general does turn around and recover from here, you're going to participate. Picking an individual equity, you may or may not. That individual equity may not participate in the rally that all the other ones do. So, safer bet would be to buy the MJ. We have a discussion that a lot of times about, okay, well, diversification versus concentration when you're investing. And with a lot of people saying, well, if you diversify, then you're protecting yourself. You're not putting all your eggs in one basket, and that's the way to go. But recently I've heard it explained differently, and the way I've heard it explained is if you are looking to hold on to what you've got, then diversify, because that is a way to protect your investments. But if you're looking to really do well, then concentrating and being right is the way you're going to do it. Now, it's hard to concentrate and be right, certainly, but most people, the way they've made their fortunes is to take risk and concentrate on one thing that they were good at and be right at it. And you could extrapolate that into stocks as well. For example, we here are focusing on VIX products and concentrating on them and being good at them, as opposed to, well, we're trading gold, we're trading bonds, we're trading natural gas, we're trading financials, we're trading all this and that and the other thing. Instead of that, concentrating on one thing and saying, We're going to concentrate on one thing and be good at it, as opposed to diversifying all over the place, being a master of none, so to speak, to use what was the thing? Jack of all trades, master of none. That is what I was referring to right there. Yeah, so some food for thought. So if we look at UVXY over the last couple of days, we have come off the absolute lows, and we've been up. We were up one. Let me move out of the way here for 1 second. We were up 1, 2. This is the third up session here, coming off the lows. However, the VIX itself, if we look at the VIX, let's overlay the VIX just on this particular chart, just out of curiosity. The problem with that is I have a hard time doing this with the split screen here, but let me try. Let me see if I can do it. There we go. VIX hasn't moved that much, it would be my point here. The VIX moved up a little bit. It moved from 1240 up to 13. So I guess it moved a little bit, but not a whole lot. This isn't a big move. It's not like a real spike here. It's not even 10%. Remember, as the lower we get in the VIX here, once we get down to, if we get down to 11, 10%, then you can get those bigger percentage moves quicker and quicker, right? Last time we talked about analyzing our risk for a 10% move. And we can do that again. I've got my risk for a 100% move here. And for that's what we were looking at actually last time as well, for a 100% move. And it shows me my P&L in 1 day, almost going to where the account loses almost all of its money. Fortunately, I wouldn't receive any sort of margin call or anything, so I wouldn't be forced to cover anything. That because I don't have any naked shorts on. I'm just long a spread. I paid for the spread in full. My position's paid for in full right now. So if we did get a spike to 38, what I would do is nothing, because I still have 40 days for that to come back in. So when you look at these specific numbers for how much risk you have on, you want to ask yourself, okay, where do they come from? And how is my buying power going to change? Will I be forced to cover at some point? If I pull up my buying power here, there's all zeros everywhere, and so I'd never be forced to cover. You also want to look at how far out your position is. And fortunately, my position is out 44 days. So that gives you time. The closer your position gets to expiration, the more risk you have on for a spike, because all of a sudden your deltas are getting more extreme, and if you roll stuff out, it's going to cost you more, et cetera, et cetera. So if stuff isn't going your way a whole lot, then you may want to continue to roll your position out further. Like, I feel comfortable with 44 days now, but if 20 days go by and we're still up, above 19, then I would probably look to roll at that point. We never want to put ourselves in a position where like something has to happen for us in the next day or two, because options give us control of our risk, and we need to use that controllability to actually do just that, control our risk. I want to look for a second at this SCIF, which is the small cap fund from India, and I'm kind of been kicking myself because this thing did do well, and I feel like I got out of it too soon. So I'm looking for a little pullback so I could kind of get back into it, because check this out. I became aware of this. What the heck is that? Oh, here we go. I became aware of this when it was trading like 29, and basically watched it bottom here, bought some for 30, and then I bailed on it at 32, and it continued to move higher here. So I bailed on it at 32. I don't really want to buy it back for 33 and then watch it go back down again. But if this does go down again, then I will look to buy some. Even I can't get out of my head all the press that's been getting about a potential recession coming, and it prevents me from buying a lot of this stuff, because I'm thinking, I'm going to be buying some sort of top here. So it's hard to get out, even if you know that some of this press stuff is, doesn't have a whole lot of basis in reality. It can be hard to get it out of your head and hard to have it not affect your trading in some way or another. All right, so that's kind of where I am today. UVXY keeping the position going. It's moved against us a little bit. This UVXY was down to 17 and change. Now it's up to 19.13. Market, however, E-mini still way over 3,000. SPX still way over 3,000. And UVXY still in almost 10% contango. So that 10% contango is going to erase quite quickly this little move up that we've had in UVXY. If this is all the market has for us to the downside, it's just a small blip here. We'll see if the day ends negative here. The market did turn negative after that news out of China. There are some elections going on for like governors and stuff that's making news, but beyond that, not a whole lot of news going on today in the markets. I appreciate all the new viewers I have. I appreciate the new Patreon supporters I have. I would ask you to please consider giving $5 for Patreon for the show, as that's the only income the show has right now. I did finally get an answer on the streaming thing that, yes, I was banned for 90 days, 30 of those days, but I'm happy that it wasn't like a lifetime ban. So 30 of those days have gone past. I did go on to Twitch for a little while, but I've pretty much been back here now. Twitch wasn't working so well for me. We'll see if we'll continue. I'll certainly be on Twitch more, but I'm not having a regular schedule on Twitch right now. I am doing these shows as if they were live. That's why you can see that it's not completely polished, because I'm continuing as if it were a live show and just recording it and uploading it immediately so that you have the most current information. Anyway, so there you go. Thanks for watching. Please reach out to me and I will respond to you. And I found my latest closing sounds for you here, which I did lift from this guy, Sky Storm. Check out Sky Storm, please. He's a gamer. But I'll see you next time.